Coming up today, stocks trade mixed ahead of Wednesday. What's going on with Apple? The dollar continues to weaken. Oil pops up. Another new high for gold. How much gold is China really buying? And will Jay Powell succumb to pressure from senators? It's going to be a massive week, guys. Let's crush it. And welcome back, everybody. I hope you're doing well. To start off, what could potentially be another big week on Wall Street? We are right on the cusp of a brand new Fed easing cycle where they're set to cut interest rates this Wednesday. The real question is it going to be a quarter of a point or half a point? And stick with me today because I'm going to show you Jay Powell's actually getting a bit of pressure from some senators to actually cut rates by 75 basis points. I'll show you the letter from senators like Elizabeth Warren have just sent to Jay Powell and what the market's actually pricing now, along with what my odds are come this Wednesday. Could have really big implications across financial markets. Going into it, stock market just sitting pretty. S&P 5633 just below all-time highs. Market may stay in this wait and see mode tomorrow as we go into Wednesday morning. Pretty bullish across the board. Now got volatility, bond yields, and the dollar downtrending across the board. It was mega cap tech that was the softest today, with pretty much all indices trading flat on the day. Once again, the financial media not really talking about gold ripping up to new all-time highs, nor do they really want to talk about the persistent weakness in the US dollar, which just fell again today. Stick with me, I'm going to show you some interesting stats to do with the commodity market and the pressure on the dollar. And just looking across the board at all sectors, did get some bump ups in financials and energy today, along with regional banks. However, it was semiconductors, the weakest today. And we can see that here in the chart of Nvidia, still just sitting above its 50-day, but the rest of the semi-market pretty soft there today, all but Intel. And I'll show you in a minute why they popped up today and continuing to rally post-market as I speak. Really strong signs of accumulation here at Intel, as it's been beaten down for a few years now. I'm also going to show you one of the hottest stocks of late, SharkNinja. Absolutely parabolic tear. I'll show you a little bit about what they do and what they sell, and I'll show you the technicals and fundamentals on the chart. First, let's just kick things off with one of the biggest stories from last week, Apple unveiling their new iPhone 16. Wall Street getting really bullish on the hopes of a new upgrade cycle, with it forecast potentially over 300 million people around the world upgrading to their latest iPhone as they integrate AI features and kind of lay the foundation for personal AI agent. Our ability just to talk to the phone and kind of take in Siri to the next level, along with all the other benefits of AI into their new iPhone. However, we're already getting some concerns about demand in China. Bank of America analysts noted lower ship times and more Pro models, possibly due to supply, inventory, and pricing factors, and that they're seeing weaker iPhone 16 pre-orders in China. Chinese economy is still in the toilet, not a whole lot of consumer confidence and discretionary spending. And China is a big market for Apple, not only for their manufacturing, but also for revenue, currently making up around 20% of their global revenue. However, Apple's generative AI updates will not roll out in languages like Chinese until next year, which could be holding back initial enthusiasm for the iPhone 16. And so Wall Street analysts are starting to question all this recent optimism around Apple, and that showed up in the price of Apple shares today, dipping down 2.78%, taking out last week's lows. So it looks like the market's initial reaction hasn't been too positive, and that's pretty much what this whole move over the last couple of months has been, in anticipation of this event. And so maybe once again it looks like a buy the rumor, sell the news event. And since Apple is still the largest stock in the market, it does have big influence over the Nasdaq. However, Microsoft coming in number 2, it's been going in the other direction, actually had a great week last week after it had been soft the last couple of months. However, according to these guys, all is good. Two of the biggest bulls on the street, Dan Ives of Webbush, Tom Lee of Fundstrat, are completely unshaken in their conviction of this new AI boom and that the tech-led bull market is set to continue. And just getting back to why we saw that pop in Intel today, we just got news of a partnership expansion with Amazon. Intel's going to be designing some custom chips for them, with Intel and Amazon to co-invest in a multi-year, multi-billion-dollar custom chip design for some AI chips. And this just may be the lifeline that Intel needed, at least to potentially put a floor in the stock, get some investor optimism back in there. Might have given Amazon a bit of leverage to work with that. And apart from Taiwan Semi, Intel still has some of the largest semiconductor and foundry infrastructure in the world, even though they're kind of being pushed aside by Nvidia, AMD, ARM, all these other companies with bigger market caps than Intel. They are still 100% a player in this market. They're also set to receive up to $3 billion from the CHIPS Act program for defense-related semiconductor production, with Intel still a preferred partner for the US government as they seek to reshore chip production and deleverage from China. And so all that's given a nice pop in Intel today. Another sign of accumulation in the regular session and just getting a nice pop here after hours as I speak. And just looking on my fundamental chart, stock fair value, it's got it around $29 a share, meaning we're about 28% undervalued. However, as you can see from my quant factor scores indicator, still not out of the woods yet. And just looking at my fundamental trends chart, the reason for all that weakness in Intel is that steadily declining revenue, we've seen the last couple of years, taking cash flow and EPS estimates with it. So still not out of the woods yet for Intel. However, at a market cap of $89 billion, there very well could be a lot more upside than downside. And it's just amazing to see companies like AMD, which for many years used to be tiny compared to Intel, now got almost triple the market cap of Intel, $246 billion. However, the whole AI trade, semis, chips, might take a little bit of a back seat this week as all of our focus and attention moves on to the Fed, with Jay Powell pretty much guaranteed to start cutting on Wednesday. With their decision set to be released mid-afternoon, we just got one more economic data print before that, retail sales tomorrow, which shouldn't have too much of a big impact on their decision. I'd say it's already pretty much been made by them. As the Federal Reserve is supposed to be free from political influence, looks like we're getting anything but that today, with it being reported that Democratic senators are calling on the Fed to cut rates by 75 basis points. Maybe they're going big asking 75, so he definitely does 50. With them warning that being too cautious in rate cuts could push the economy towards a recession. And this is the letter here from Elizabeth Warren, which I'm sure Jay Powell enjoys regularly getting letters from her, telling him how to do his job. You just imagine if it was another person asking for this 75 basis point cut whilst they were in power. Might get a little different reporting on that, right? Anyway, Elizabeth Warren is urging the Fed to cut Fed funds rate by 75 basis points, telling them the Fed now has confidence in inflation moving towards its target of 2% and data indicating slower job growth. Now is a time to swiftly move forward with rate cut. Even saying it may be too late, that Jay Powell's delays have threatened the economy and left the Fed behind the curve, saying inflation's fallen to 2.5%, well below the mid-2022 peak of 7%. Going on to say the FOMC must cut rates by more than 25 basis points and that they should go 75. Finishing by thanking Jay Powell for his attention to this matter. And this is kind of putting Jay and the Fed in a bit of a bind and a real tough spot here. I mean, if they go 50 basis points, that could set the wrong signal to markets, with markets interpreting that as the Fed's really worried, everything's falling off a cliff, and instead of that rally like we got in September 2007, maybe markets go the other way. Because right now the economy is not really screaming an emergency. Of course, we have softness in the jobs market, inflation's really come down. However, overall, GDP, the consumer, retail spending, credit markets are relatively holding up. Not too bad. The one thing we've got is really heavy short-term bond yield, pretty much been a huge pylon into the short end of the curve. Everyone anticipating Fed rate cuts this week. Over the last couple of months, piled into short-term bonds, and we can see that in that sharp slide in the 2-year over the last couple of months, currently at 355. And so even though we were seeing firming odds late last week towards a 50 basis point cut, that has grown significantly today on the back of that letter from Democratic senators pretty much telling Jay Powell he's got to cut 75 basis points. Now got Fed Fund Futures actually given 2/3 chance that they will cut 50 basis points on Wednesday. Now only 1/3 chance they go 25. So finishing up on Friday's session, I was at 70-30. 70% chance they'll do 25 basis point cut, 30% they'll go 50. However, now that this process of setting interest rates, which is not supposed to be political, now right in front of an election, we've got some senators demanding a 75 basis point cut. Maybe Jay Powell does want to please his political masters and keep his job. Either way, we've certainly got to add some weight to the case for a 50 basis point cut. I don't think he'll go 75 and do what Elizabeth Warren wants him to. I'd be really surprised if he did. So would the market. I think they're just saying 75, so he goes 50. However, myself, I would increase the odds. However, at this stage, I'm probably looking close to 50-50. If not, maybe slightly more odds that he will still go 25. Maybe I'm 55-45. But like I said, I definitely have to acknowledge the price action, not only in the markets, but also the political pressure on Jay Powell to deliver the economy a big rate cut right in front of the election, possibly putting the markets on a sugar high going into it. But either way, this is still quite a lot of uncertainty. In the markets, all of us are kind of scratching our heads, wondering what Jay Powell exactly is going to go for on Wednesday. But like I said, I'm still giving slight favorite to a 25 basis point cut. Going to stick to my guns just like I have been for the last 3 months and predicting the Fed was going to cut 25 basis points in September. But now for sure, we can't be surprised if he does start off big. But for my American friends, what that means for you is a lower cost of capital. Any floating debt you got should come down, along with yields on money market funds, other short-term cash rate. Like I've been saying the last couple of months, if you could lock in, and this is not only for my American friends either, all around the world. You can lock in some solid safe yield around 5%. Say that's a bit of a fleeting opportunity if you're looking for some fixed income. I myself don't have any bonds or CDs, TDs or anything like that. I prefer to earn my 5% from the stock market and international stocks, particular of late. But we're getting down to crunch time, and what happens going forward all depends on whether the economy holds up, GDP holds up, the jobs market holds up. If so, then once we get a lower cost of capital, that can bode well for the stock market going forward. It can actually be higher 12 months from now. However, if the economy contracts, cuts and we go into a recession, well then that's obviously not good for the stock market. But like I said, Goldman Sachs estimates GDP growth for Q3 will come in about 2.5% annualized. And for a technical recession to occur, we have to get 2 consecutive quarters of negative GDP growth. And of course, this is a bit of a lagging indicator. We're looking at jobs market, as that'll lead GDP. People lose their jobs, they stop spending. The next GDP print we get comes in lower. However, Goldman Sachs is tracking all that stuff and they estimate Q3s to come in at 2.5%. So like I said, the economy's not fallen off a cliff here. And so some senators calling for a 75 basis point cut, well, it's almost comical, isn't it? But according to Tom Lee, says we should get ready for the stocks to embark on a weeks-long rally after the Fed cuts rate. Are we going to get that repeat of 2007? A big rip-up even after they cut by 50 basis points back then. However, like I showed you guys on Friday's video, the bull market made a top a few weeks later, rolled over into one of the worst bear markets of our lifetimes. Hopefully that doesn't happen again. But on the other hand, we've got a building narrative from some Wall Street analysts saying, resist the temptation of AI and bet on safe defensive stock like utility, classic defensive sector. We're already going toe-to-toe with tech, consumer staples, and other sectors that can benefit from lower rates like REITs. Good news for AI bulls. We've got Morgan Stanley's Mike Wilson calling the AI theme overcooked, with him too saying investors should shift to defensive shares, and others say to stick with more boring income and kind of ignore growth. And I've been doing a bit of that myself as well. However, I'm playing it both ways. I've still got some exposure to growth. I'm just being very careful and not buying stocks with a huge amount of debt. I prefer growth with conservative balance sheet and also some defensive names as well. Like I said, just with more of an international tilt. And something not many people are really talking about is the potential for a resurgence in inflation. Things get too good again. Animal spirits flying. And so just like in the mid-1970s, inflation was coming down, the Fed started cutting rates again, and it shot back up into a second and higher wave, surprising a lot of people, causing a lost decade in the stock market, although it made for one of the best decades in commodities. Great hedge on inflation, which very well could happen again. And although there were key differences from back then, the oil embargo from the Arab producing nations, which had much more leverage over the states back then with oil. It's why they created the Strategic Petroleum Reserve. And now the US produces more oil than every other country. However, what they didn't have back then was 9 trillion of new money pumped into markets from the Fed and rock bottom interest rates and a government spending like crazy, creating a huge amount of new currency. And so even though we may not get the oil shock that caused the inflation in the 70s, we could have this structural embedded inflation from simply an oversupply of US dollars. That's not just going to magically go away unless we see a really deep, dark depression potentially cause some deflation. But if everything's humming along, then the risk of inflation is to the upside. And here's a look at the front page of the journal from exactly 16 years ago, September 15, 2008, right in the heat of the moment. Lehman Brothers, Merrill Lynch, AIG, all getting absolutely whacked in the market, forever changing, with it pretty much the peak of fear, even though markets didn't bottom out till about 6 months later in March 2009. And so now markets are pricing in the real possibility that Jay Powell could cut big on Wednesday. We've seen that not only bond markets, but the US dollar weakening again as well. I was actually able to find an article on one of the mainstream financial outlets today talking about it. And so basically a currency fluctuates with an economy's strength and weakness, the amount of inflation, the supply of that currency, government spending, the confidence in that economy, inflows and outflows of foreign capital. All this stuff affects the value of a currency. And so right now there's a lot of headwinds for the US dollar, especially if government spending doesn't get under control and things keep going in the direction they've been going the last 3.5 years. And that's why we're seeing that slide again today. And why my stock picks portfolio had its best week last week since inception is because a lot of my portfolio is tilted away from the US dollar, being long international stocks and commodity stocks. There was a big rotation last week into those types of stocks. And like I've been saying, this could be just the beginning, as the US dollar is really sitting at this big key level of 100 where it's turned before, and even though it's come down a lot since the peak in 2022, it could still be significantly overvalued here, and that might have helped give oil a bit of a pop today, even though we've been getting really bad data out of China this last couple of months. A lower US dollar is a tailwind for commodity prices that are priced in the dollar, and like I've been saying, the geopolitical setup is the worst in our lifetimes, with the current sitting president, which is really in a kind of dangerous position when you think about it. Someone who knows they're not going to get back in, may leave us all with a parting gift of plunging us all into World War III, as they could still give permission to Ukraine to use Western weapons to strike deep within Russia, in which Russia's responded and officially announced to the world at the United Nations Security Council that any long-range NATO missiles used by Ukraine against Russian territory will be a formal declaration of war by NATO on Russia, with some saying this regime wants war with Russia That's why they never tried to negotiate. And that real prospect of the biggest global war between superpowers we've ever seen in our lifetimes could help to keep a bid in the crude oil market, as once again it's curious timing how this is all happening in front of an election. But just moving on to another commodity market we haven't talked about for a while, copper. Just got news out from the world's largest miner coming out of Australia, BHP, predicting that the AI boom will nearly double demand for copper, as it's a necessary material for electrification and AI data centers will require power capacity to expand. They think AI centers will constitute 67% of copper demand by 2050, up from current levels less than 1%. Global copper demand to hit 52.5 million tons a year. And along with a lot of other key commodity markets, there's shortages, supply deficits, and that's thanks to a decade-long underinvestment. And thanks to the boom in AI, that's driving demand going forward along with expectation. And there's a look at the price of copper futures. Like a lot of commodities have been pulling back the last couple of months, starting to tick up over the last week, but still being pretty good performers so far this year. And we've seen some pops of late. And other commodities that can be used in the AI industry like silver had a really good week last week with a lot of silver bulls posting memes like this, saying the dam's ready to break on $35 an ounce silver level, and that all the naked shorts could get absolutely washed out. We're also getting mysterious reports of a lot of silver being withdrawn from London vaults. But the granddaddy of them all is, of course, gold. I actually managed to find an article on financial media as well today. It wasn't too many. This was one of them. Gold is at escape velocity. Could be a warning for stocks. Gold market certainly is telling us something. Weak US dollar, geopolitics. Now the prospect the Fed could cut rates by 50 basis points, along with the potential for inflation to come back. All that's super bullish for gold. Now we're also getting news that the Saudis have been secretly buying 160 tons of gold in Switzerland, as they too look to move away from the petrodollar. US dollars getting more closer with the BRICS nations, and these countries just can't get enough of it. Their mandate now is to get their reserves into gold, to get off the US dollar, start becoming more independent, trade with each other in their own currencies. And of course, not only is the power and influence of the BRICS rising, but they're also sending their worst to flood our countries, of which the elite wokists welcome in with open arms, as of course they don't have to deal with them in their gated communities. It's the rest of us that has to actually deal with it. Just like we're seeing in Springfield, Ohio. Now we're seeing China sucking up more than a quarter of the world's gold demand so far this year. And the trend is clear. This has already been going on for a decade. China's holdings of US Treasury steadily decreasing, while at the same time increasing their reserves in gold. Trading activity exploding in Shanghai as well around gold. And even though the Chinese economy is weak at the moment, we've actually got a little bit of signs of deflation. You could look at this two ways. You could say there's really dark stormy clouds in the sky, stay away from China, they're done for now. Or it could be of a case that it's always darkest before dawn. And if the good times do come back to China, along with demand and some inflation in their prices, that could really set off a new bull market in commodity. And other things like uranium, the world's going to need a lot of. Even though China's economy's been weak, they're already head and shoulders above the rest of the world when it comes to their electricity demand and that growth over the last decade that's set to continue. And just looking at global reserves, US dollar's still almost half at 48%. Gold, number 2 currency held, 18%. And you've got the euro, the yen, the pound, and a few others. But you can see here in the yellow, gold is expanding. And what's been beaten down for what seems like forever is gold miners. Looking at the ratio of gold miners to gold, with a lot of valuations in miners still really cheap, still plenty of catching up to do, even if gold doesn't move anywhere. And of course, there's going to be a big correction and pullback in gold at some point, maybe just around the corner, now that it's getting a lot of traders' attention, even though the media is trying to ignore it. A lot of people like us have been noticing it, and so there's bound to be a washout soon. But that could be another opportunity for re-entry. But for the here and now, heading into Fed rate cuts, the election, gold's been on absolute tear, trouncing the S&P 500 so far this year, and just commodities as a whole, maybe trying to find a bit of a bottom here after they've pulled back for the last few months, really helping to get inflation down. But then look out if commodities come back too hard, inflation around the corner. However, current day leaders can worry about that after the election, right? Okay, just moving on from commodities, thought I'd share with you guys today an interesting stock. It's been on absolute tear. Shark Ninja, with it actually being 2 brands. First brand being Shark, which makes innovative products for around the home. Robot vacuum that mops, empties, and cleans itself. Hairdryer, cordless vacuum cleaner, and all kind of really nifty and innovative, premium priced home appliances. Even things like hair care, fans, air purifiers, cleaning appliances, even claiming to having the #1 vacuum brand in America. Then you've got the Ninja brand with a lot of kitchen and outdoor appliances as well. Coffee machines, blenders, countertop ovens, grills. Once again, really premium product for around the home. And the business is growing. Revenue coming in last year at $4.25 billion. Current market cap at $14.5 billion. Price to earnings ratio of 58. Stock's been on absolute tear. Recent earnings, really good beat, 19%, 71 cents per share. And it's just been on absolute tear ever since it came to market in just July last year. $30 a share. Here we are at $103 a share. It's already tripled. Parabolic tear. And once again, just another sign of the mixed results in the economy. A lot of consumers are out there struggling, definitely not buying any Shark Ninja appliances. However, top 10, 20% income earners still got cash to burn, and companies like this, along with some other premium retail and restaurant chains, are still doing pretty well. So I thought that was just interesting to share with you guys today. There's still a few hot stocks out there like Shark Ninja, ripping up to new all-time highs. There's a look at your economic calendar. Always a slow start to the week. Getting into tomorrow, some inflation data coming out of Canada. Year over year expected to be 2.4%. We also get retail sales from the States. Year over year expected to be 2.2% growth. If that comes in a lot weaker, may just further add weight to the case for the Fed to go half a point, but we won't know until Wednesday. After we get some inflation data from the Eurozone, it'll be around mid-afternoon. We get the Fed's interest rate decision. Half an hour later, Jay Powell will present it to the media along with his justification. And like I said, it'll be interesting to see if the Fed Fund futures market is right. We'll see how this changes tomorrow going into it. But either way, the market definitely seems to have responded from this political pressure on him to go big, and which senators shouldn't really be telling Jay Powell what to do. Federal Reserve is supposed to be independent in their decision making and free from pressure. However, apparently it's okay if it's only coming from certain people. Just getting back into the charts, we do have improving breadth. Market starting to broaden out. We can see that in 52-week highs coming back. And once again, equal weight indices, mid caps and small caps doing better than the market cap weighted indices. Got volatility starting the week at 17. Option dealers still asking for some premium over realized. High yield bonds breaking out to new 52-week highs again. Bitcoin trading a bit heavy, and the growth versus defensive sector spreads still a bit soft as well. And interestingly, inflation expectations slightly starting to curl back up, maybe finding a bottom here, whilst we've got a bit of weakness in the stock market's biggest stock, along with the AI trade pulling back today. That's all for this Monday to get you prepped for this week. Certainly could be an interesting one, and I look forward to breaking it all down for you again tomorrow, going into the big day of Wednesday. Thanks very much for sticking with Click Capital, and I'll see you again tomorrow. Cheers.